And we're going to get started now. Thank you everyone for joining us. As you can see on the screen, we have Ron Ricard with IPX 1031, and he's going to talk this afternoon about what's going on with 1031 exchanges and all those things as it relates to 2020 in our current market. So Ron, take it away.
Thank you very much, Jody. Well, hello everybody. Thanks so much for joining us this afternoon. Yeah, what I'm planning on doing is kind of going through the 1031 rules and process. In doing so, I want to focus a little bit on what is happening with the, what's happening with today's market. I want to talk about the extensions that the IRS has provided and what they still might provide. I also, near the end especially, will get into how we might be able to use our current situation when we're talking about marketing. So that is something I expect to be able to hopefully get you guys have questions about. If you do have questions, please put them in the chat box. If they are something that we can answer right away, Jody is going to let me know. Otherwise, we will answer them at the end. But please do put any questions you may have in the chat box. So let's go ahead and get started. All right, so my name is Ron Ricard with Investment Property Exchange. I know many of the people on this phone call or Zoom call already. I've been doing this almost 20 years. And so what is a 1031 exchange? 1031 refers to the section of the tax code that allows you to sell investment real estate, buy replacement investment real estate, and in doing so, you get to defer paying taxes on the profit that you've made. So what does that mean in English? You have a rental house. It's been a rental for the last 20 years. You want to sell that and buy a fourplex. You go through the regular listing process. At the close of escrow, the money comes to what's called the intermediary, a company like us. You then go help the client find that fourplex. We send the money to the title company on that side. So they sold a piece of investment real estate, they bought a piece of investment real estate, and because they didn't touch the money, they get to defer paying taxes on the profit that they've made. Now, important word there, defer, not eliminate, right? So you got a client who buys the house, sells the house to buy a fourplex, later they sell the fourplex and buy a sixplex. Now they're old and tired and they just sell it and pay the taxes at that time. When they do pay the taxes, they are paying taxes from the house, the fourplex, and the sixplex. They are just deferring taxes, not eliminating taxes. Where this may become relevant to you, for those of you who were real estate agents back in when the crash happened in 2008, 9, 10, I know a lot of people who sold their investment property at a loss. And they thought to themselves, well, I've lost money on this property. I don't need to do another exchange. When in reality, they still did because they still had deferred gain from the first property. And overall, they still had a tax liability. So it's really easy for somebody, and I'm not saying the housing prices are going to go down 30% or 50% like they did back then. But if we do end up in a recession, and whether their property is local or the property is in other markets, and if prices do go down, then there is a possibility people are going to say, well, I don't need to do an exchange anymore because I lost money on this property. When in reality, they overall still have a gain. So that's where you do have to be careful. One thing I get often the question about is, why bother doing an exchange if I'm only deferring the taxes? There are two reasons you always want to encourage your clients to do an exchange. Number one, you want to pay your taxes today or tomorrow. For most of us, tomorrow. The way I look at it is this. If I make $300,000 of profit on something and I got to pay $100 to the government, I only got $200,000 in my pocket. But because I get to do the exchange, I get to reinvest all $300,000. And that $100,000 that you're not giving the government yet, you get to use that to buy more real estate. But the real reason you do the exchange is ultimately, hopefully, you never have to pay the taxes. Because eventually, sadly, one day we're all going to die. And when you die, you win. Well, be honest. When you die, your kids win. Because when you die, whoever inherits the property from you gets what's called the step up in tax basis. Make sure we're all on the same page here. I bought a property years ago for $100,000. Today it's worth $1 million. If I sell it, I have to pay tax on $900,000. Doesn't matter how long I've owned it. But the day I die, whoever inherits the property from me, their basis on the property is the value of the property at my time of death. And if your kids are like mine, the day after my funeral, they're selling all my real estate. Now, the good news though, at that point, it was worth $1 million when I died. That becomes their basis. And therefore, when they sell the property, they have no gain, and therefore they don't have to pay any taxes at all. All the taxes that you would have paid disappear. As a matter of fact, if you're working with a married couple and they own the property as community property or in a trust that's designed as community property, the death of one spouse gives that surviving spouse that full step up in basis. So this is something where if you know you have a client whose spouse passed away, you know, I'm not suggesting you follow them to the funeral, but maybe, you know, a couple months later, follow up with them, see how they're doing with their real estate. They may have an opportunity, the surviving spouse may have the opportunity to sell that property and have zero tax consequence. Now, mind you, please, you will never tell the client they got to step up in basis. You are not their accountant. You are not their estate attorney. So you do not know, but it is something they should be checking out with their own tax professionals. And if their tax professional says, yes, you got to step up in basis, then great. They may be able to sell their house, their investment real estate, their stock portfolio, anything, and have zero tax consequence. That's the real beauty of the 1031. Hopefully nobody ever has to pay the taxes. All right, there's a term you hear about in exchanges all the time, like kind. What you sell and what you buy have to be like kind. I'll make this really easy. All investment and business real estate is like kind with all other investment or business real estate anywhere in the country. You can sell a house and buy a shopping center. You can sell a farm and buy a fourplex. You can sell bare land and do an exchange on that land to income producing operations like a rental house or a fourplex or apartment building or whatever. Any kind of investment real estate for any other kind. Where people get messed up on this is that a lot of times when they hear the term like kind, they don't realize that up until very recently, we used to do exchanges for personal property, where people would sell an airplane to buy an airplane. They would sell artwork to buy artwork. I've done exchanges on farm equipment, on gas station equipment. I've done exchanges on Budweiser distribution routes. But that's what like kind referred to. If you sell a cow, you have to buy a cow. If you sell farm equipment, you have to buy farm equipment. But as of 2017, the end of 2017, when Congress passed that new tax bill, they completely, totally eliminated all personal property exchanges. So now 1031 is only about real estate. So the term like kind really doesn't matter that much anymore. Okay, so don't worry about selling residential to buy commercial, to buy agricultural, all perfectly okay. But what about your primary residence? Your primary residence is obviously not covered under 1031 because it's not investment real estate, as you probably should know. Under Section 121, as long as you've lived in the property 2 of the last 5 years, you get to keep the $250,000 or $500,000 in initial gain tax-free. Now, around here, that's not that much anymore. Now, remember, when this law was put into effect in 1997, even in Santa Clara County, $500,000 of gain in your house was a hell of a lot of gain. Well, it's not anymore. And now it's really common for people to have more than $500,000 of gain in their property. So is there anything that people can do with highly appreciated primary residences? Yeah, there are 2 things. First off, is there any portion of the property that you are already deeming to be business or investment real estate? Do you have an ADU? Do you rent out the basement? For realtors, do you have a home office? If you are showing a percentage of your property as business or investment or rental real estate, then that portion of your property can qualify for 1031. So using this example, you got a realtor who's selling $1 million house. They are declaring on their tax return 20% of it is their home office. So 80% of it, they still get the full $500,000 exemption against, and the other 20% they can do a 1031 exchange on. By the way, for those of you who are getting my newsletter My newsletter this morning is specifically an article I wrote about how we may be seeing a huge influx in people having home offices, because a lot of businesses right now are suggesting their employees permanently start working from home. And in some of those cases, not all of them, but in some of those cases, they will be able to start declaring part of their house as a business property. So they may be able to qualify for this going forward. By the way, side note, if you aren't getting my newsletter, if you didn't get that newsletter, you're interested in getting it, send me an email, send me a text, call me. I'll add you to the distribution list about that, but that literally just came out this morning. So again, the key here though is, what are you showing on your tax return? If you have a home office, but you're not showing it on your tax return, it does not qualify. It has to be property. It has to be something that you've been telling the IRS how you've been using that property. All right, but a lot of times they don't have a home office, they don't rent out any of it. So is there anything else those people can do? The answer is yes, move out. Turn your house into a rental for a couple of years. After renting it for a couple of years, is your house now investment real estate? Yes. Does it still qualify as a primary residence? Yes, because it still meets the criteria of having lived in the property 2 of the last 5 years. So you sell the property for $2 million, assuming it's a married couple, they pocket the 500, and then they could do a 1031 exchange on the remaining 1.5 million. Note, you only get to keep the exemption. Everything else, including the basis, has to go into the 1031 exchange and into other real estate, other investment real estate. So it is not a way, you're not just reinvesting the excess profit, you're reinvesting everything other than the exemption. Now, this does not work for everybody. If you need the value of your house to go buy yourself another house, it's not going to work for you. But where do I see this a lot? I see this a lot with people who are moving to senior facilities, or they're moving into their second homes, or they're moving to Arizona or Nevada or someplace where they're buying really big houses for $300,000, where they don't need to sell this house to be able to do that. So this is a very, very common strategy. If you're dealing with somebody who would love to sell their house, but they feel trapped by all that excess gain because their gain is way above the exemption, this is definitely something you want to be talking to them about. Side note, pretty much everything we talk about today, any subtopic like this one, I have a write-up, a PDF that I can email to you that you can share with your client about it. So again, this is becoming a very common tax strategy. I'm probably doing a couple of these every single week. So again, talk to your clients who have these highly appreciated primary residences. There is a way out for them. All right. What other kinds of properties don't qualify for exchange? Second homes. This is really pretty important. Second homes are not considered to be investment real estate. Now, what do I mean by second home? I mean that little house on the beach that you like to go to on weekends. Now, if it's in Hawaii and you go there for a couple weeks per year, but when you're not there, you're renting it out, that's a vacation rental. The IRS does allow 1031 for vacation rentals, as long as you meet the IRS definition of vacation rental, which I can share with you if you want it. But second homes in and of themselves do not qualify. Most of you are thinking, well, nobody has a second home in Santa Clara. Oh, yes, they do. A lot of people. And where we see this a lot is people who have a property that they're letting their family members live in. If you're letting your kid or your mother live in a house and you're not treating them like a regular tenant, including collecting market rate rent, then to the IRS, that property is for the benefit of the family and therefore treated as a second home. So when your ne'er-do-well son finally moves out and you want to sell that house, you're going to have to pay taxes on all of the capital gain because it's not a primary residence, so you don't get the $500,000, and it's not a rental because you haven't been treating them like a tenant, and therefore you'll have to pay gain on their taxes on all of the gain from that property. Be very careful about second homes. If you got a client who you know has been living there, or the kids have been living there for little or no rent, they need to start treating it like an investment if ultimately they're going to want to sell the property and do an exchange. Flipping real estate is not considered to be investment real estate. Flipping real estate is considered to be a house purchased for resale, not purchased for investment. So I always liken it to going to the store to buy a can of soup. That soup is not investment. That soup is inventory. They buy it from Campbell's, they're selling it to you at a profit. That's inventory. They buy a chicken, they cut the head off, they wrap it in plastic, and they're selling it to you. That's a fixer-upper. They bought it, they fixed it up, and they sold it to you. So so flipping real estate does not qualify. Similarly, development does not qualify. You buy a big empty lot, you build a house on it, you sell it, you are a developer. That's not investment. As a rule, investment real estate is real estate you're getting rental income from, real estate that you are running a business from, or real estate that is held for appreciation. And the last one, really, land is the only thing that you can honestly say you're holding for appreciation. You cannot buy a house and just let it sit empty. IRS will not believe you that it's being held for appreciation purposes. So, so that's typically what we think of when we think of investment real estate. All right, you have a new new listing. It's going to be a 1031 exchange. This is your first one. What are my first words of wisdom? Don't panic. There's absolutely no difference in listing the property if it's an exchange or if it's not. There is very little for you to do different from a regular transaction. Same listing agreement, same MLS, same tour, same title company, same absolutely everything. There are only 3 things I want you to do extra if your client's going to do an exchange. Number 1, please make sure the client knows what the hell they're doing. You know, give them a brochure, give them some information, have them talk to the intermediary, but the key is make sure the client understands what they're doing. Every year, I get clients who thought they knew what they were doing, or agents thought the client knew what they were doing, and they did not, and it did not end well for anybody. So please make sure the client understands what the rules are of the exchange. And my suggestion is educate them before you even list the property, so they know what they're getting into and what the steps are. Number 2 is you do need to disclose it to the buyer. Sometimes you'll see something called a cooperation clause. Seller to cooperate with buyer's 1031, or buyer to cooperate with seller's 1031, or seller to do 1031 exchange. A lot of brokerages right now are strongly suggesting that their agents use the seller's intent to exchange addendum. Again, the key here, though, is this is strictly a disclosure. It is not a contingency. It has 0 effect on the buyer. So this is also something to know about if you are working with a buyer and the seller's agent says, hey, I'm going to do an exchange. The seller's doing an exchange. You can tell your buyer, don't worry, it has no effect on you. The only reason that's in there is because the closing statement that the buyer is going to receive from the title company at the close of escrow is going to show the intermediary's name on there. And that's the only reason that the buyer needs to be told the seller is doing an exchange. So educate the client, disclose it to the buyer, and number 3, please get the intermediary involved before escrow closes. If you close escrow and the intermediary is not involved, then the title company will send the money to the seller and they will pay taxes. The intermediary must be involved before escrow closes, even a day or 2 before. I mean, I've set up plenty of exchanges the day before escrow closes. Not a lot of fun for everybody, but the reality is it can be done very quickly. So other than this, everything else about your role in an exchange is exactly the same. All right, so let's get to a couple of the rules that we need to dive a little bit deeper into. Timelines: 45 days to identify what you're going to buy, 180 days to actually buy it. We'll talk about the identification rules in just a second, but essentially what it means is within the first 45 days of when escrow closes, you need to know what you're going to buy. Now, technically, do you have to be in contract by that 45 days? Technically, no. Technically, you just gave us a list of 3 properties and you have to buy from that list. But if on day 46, all 3 of those get sold to somebody else, you're out of luck. Your exchange fails, you get your money back, you pay taxes. So really what it means is by day 45, be in contract, have your inspections done, have your loan approved, be locked in. Now, a couple things about the 45 days. First thing to realize is the 45-day clock starts at the close of escrow. What am I seeing today? What are we seeing in today's market that's a little bit different from normal? One thing I'm definitely seeing lots of longer escrows. I'm seeing a lot of 45, 60, 75-day escrows, 30-day escrow with an option to extend 30 days, something that gives the seller more time before that 45-day clock starts. So to the degree that your seller is worried about the clock, discuss this with them. And if there's a possibility for them to, get more time from the buyer, build in that extra time so that the client has more time before that clock starts. Because once it starts, it ain't stopping. Now, I'll mention also at this point that there is something called a reverse exchange. A reverse exchange is exactly what it sounds like. It's where you are buying first and then selling. I am not going to go in depth into reverse exchanges because I could literally spend a half hour going over it. But know it exists. Know that it's a lot more expensive, and there are different ways of structuring them. But if you get a situation where the client needs to close escrow on what they're going to buy before they can close escrow on what they are selling, then we can talk about a reverse exchange. Note, if you find a property that you want to buy, but the seller is willing to make it contingent on the sale of the relinquished property, then it's a regular exchange. It doesn't matter when you go into contract. All that matters is when the escrow closes. So as long as you're closing escrow first on the one you're selling, you can close escrow on the one you're buying the very next day. Now, where are we in today's market? When our shelter in place / COVID / current situation hit in mid-March, I spent about 3 weeks peeling people off the wall. And they were all saying, oh my God, I can't find property. I can't even go look at property. And my inspectors won't go out. The appraisers won't go out. I don't know what I'm going to do. Are we going to get any kind of relief from the IRS? And the answer is yes, we got relief. That's the good news. Now, stepping back just a second. The IRS does have the authority to extend these rules, the 45 and 180-day rules, when there is a federally declared disaster for a specific event. Typically, we think of a hurricane, an earthquake, a tornado. In Northern California a couple of years ago, we had extensions when there were the fires in Napa and Sonoma and Paradise and Shasta. If you were affected by those fires and you were in the middle of an exchange when they happened, you got extra time to finish your exchange. This is what we and NAR and a bunch of other real estate organizations pleaded to the IRS, please give us some kind of an extension. And they finally did in early April. Now, the good news is if you close escrow anytime from mid-February all the way to the end of May, you got extra time. The last line is really the one to look at. So if your 45th day fell on or after April 1st, then instead of April 1st or whatever is your deadline, you got all the way to July 15th. What this means in effect is if you close escrow May 29th, you got all of an extra 2 days to identify. Whereas if you close escrow in mid-February and your 45th day was April 1st, you actually got 3.5 extra months. So there was not a lot of fairness to this. The key takeaway for you right now is anybody who sells their property now will not get more time. These extensions effectively have expired because now July 15th is well before the 45-day clock would start. So at this point, there are no extensions that you could be asking for from the IRS. Note that we have, along with NAR and others, have asked the IRS for longer extensions, for more comprehensive extensions. However, we have not heard back from the IRS yet. And to be honest with you, my opinion is we're not going to, because I think as parts of the country reopen, I think the pressure is off. And I just don't see the IRS granting a lot of extensions going forward. Mind you, if we have a second wave, we go back to another shelter in place, God knows what might happen, who knows. But as I'm seeing things today, I would not expect any additional extensions. So let your clients know if they're selling now, they are going to be working under the regular rules of the 45 days to identify and the 180 days to close. All right. Now, how many properties can you identify? There are 3 rules, only 2 of which you will ever use. The one on the right and the one the one on the left and the one in the middle. If you're only going to buy 1 or 2 properties, you can identify up to 3 properties. If your goal, though, is to sell your property in Palo Alto and go to Las Vegas and buy 10 houses, that's okay. But now you'd be under what we call the 200% rule. That means you can identify up to 2 times what you sold. So if you sell a property for $1 million, you can identify up to $2 million worth of property. Don't combine these rules. They're completely independent. If you identify 3 properties or fewer, there's no dollar limit. You can be identifying 5, 10, $15 million properties. If you, though, identify more than 3, that's when you're capped at that 200% dollar amount. Now, there is a 3rd rule to identify. It's called the 95% rule. I call it the 100% rule. It basically means if you blew both of the rules, you identified more than 3 and more than 200%, your exchange would still be good as long as you buy everything that you've identified. If you buy everything you've identified, you're okay. In reality, that's not, I probably have seen this done maybe 3 times in my nearly 20 years of doing this. So as a rule, focus on the 3 property rule or the 200% rule. All right, how much money do you need to reinvest in the exchange? The answer is very simple, all of it. It is not the equity, it's not the profit, everything. If you sell the property for $1 million, you need to buy something for at least $1 million. Can you buy more? Yes, 2, 3, 5, 10 million if you want. Can you buy for less? Yes, but you're going to pay tax on the difference. As you probably know, that's referred to as boot. So if you sell for $1 million but only buy for 900, you just pay tax on a $100,000 difference. A lot of clients are okay with that, but if you want to defer all your taxes, you want to buy equal or greater in value. Part 2, all of the cash, all the equity from the sale has to go towards the new property. Any cash left over, you pay tax on. So what does this mean? It means if there was a loan on the property, yes, you're probably going to be replacing it. Note, you do not have to replace the loan with another loan. You can replace the loan with your own cash. So let's use an example. You're selling your property for $1 million. You have a $200,000 loan on the property. So you got $800,000 that comes to the intermediary. You got to buy $1 million worth of property. You got to use that $800,000 as a down payment on the new property. You got to make up that $200,000 somehow. Yes, it probably will be another loan, but if you have cash in your pocket or seller financing or some other way to make up that difference, that's okay also. Obviously, the key here is any money that you touch, you pay tax on. So the key to remember is you want to make sure the loan is commensurate with the amount of debt or the amount of equity you need so that you're not getting too big of a loan. I had a situation last year with a woman. She sold her property for $2 million all cash. That $2 million came to me. She went to go buy a property in Florida for $2.8 million, a shopping center, by the way. And for some reason, the lender decided to give her $1 million loan. Well, even though she bought a property that was more expensive, because she had cash left over, she had to pay tax on that cash. So you want to make sure the loan amount matches how much money is in the exchange. All right. So how do we think about this? This is the thumbnail test, as I put it. Did you buy something equal or greater in value? And did you use equal or more of the equity? As long as both of those are replaced, by default, the debt's is going to be replaced and you've deferred all of your taxes. All right, so that's the basic rules of the 1031. You got a very strict timeline. You gotta buy something within the equal or greater. You gotta buy investment real estate. Now there are some really common myths. These are things that people I get asked almost every single week. People say,
Ron,
yes.
We did have a question that came in, and before we get to myths,
please.
It says, if I sold my property for $1.5 million after renting it out for 2 years, how much do I need to spend on 1031 after keeping $500,000?
$1 million. So if the property sells for $1.5 million, assuming you're a married couple and you lived in the property 2 of the last 5 years, you would get to keep your $500,000. And so from the $1.5 million, you get to keep 500, and the remaining $1 million is what your bogey would be going forward into the 1031 exchange. Note, I didn't care what you bought it for or what your basis is. It's basically the sales price less the exemption. If you're single, you get to keep 250. You'd have to buy 1.25 million.
Thank you.
Okay, good question though. Thanks for that clarification. All right, exchange, the first one there. Exchangers are basically looking for people to swap real estate with. I get this question about once every other week where someone will say, hey, I have a duplex. Do you know anybody who has a fourplex who wants to swap it with me? Believe it or not, this is how 1031 exchanges used to be many, many, many years ago, back in 1920s all the way up until into the 60s. You were literally swapping real estate with people. That's not the case anymore. 99% of the time, you are selling real estate to one person, buying it from another. So you do not have to swap real estate with somebody directly in order to have an exchange. Also, exchanges have to be done simultaneously. Yes, again, that's how it used to be. But in the late 70s, there was a court decision known as the Starker decision. And in 1984, Congress actually amended the 1031 rules to allow for the 45 and 180 days. So it does not have to be simultaneous anymore. I just did an exchange for a woman. She was a realtor. She's 90 years old. She hasn't been in real estate in 25 years. But to her, in her mind, the exchange still had to be simultaneous. I had to explain to her, not anymore. That's not the case anymore. Another common myth. Exchanges are expensive and really a lot of work. No, they're not. There are a couple pieces of paper to sign. They are in round numbers around $1,000 to do. So they're not expensive. They're not hard. They can be done very quickly. And I've done exchanges for properties that are $50, $60, $70,000, as well as ones that are $50, $60, $70 million. So it's not that difficult to do an exchange. Also, another common myth is that exchanges automatically put a target on your back and you will be audited by the IRS. Not true. We have no evidence at all that just because you did an exchange, you are more likely to be audited. Now, there are certain things the IRS will look for, such as dissolving a partnership or doing things with family. I mean, there are lots of ways you can trigger an audit because of something you do wrong on your exchange. But just because you're doing an exchange does not mean you're more likely to get audited. Another common myth, I hear this one a lot from accountants, unfortunately, that if you live in the property, you can't also do an exchange. Again, not true. It's possible for a property to be both an investment and a primary residence at the same time. The IRS back in 2005 gave us 6 different examples of how people can do this. So it's very common for a property to be both investment and residence at the same time. The last common myth is that you don't need me. You don't need an intermediary when you do an exchange. Not true. An intermediary has to be involved in any 1031 exchange that you do. And it cannot be your realtor or your CPA or your mother who holds the money. It has to be a neutral third party with whom they have no other financial connection. So that's why as intermediaries, we don't sell you anything. We have no real estate to sell you. We don't replace title. Our job is strictly to hold the money between when you sell something and when you buy something. And we are a required part by the IRS, required of virtually all 1031 exchanges. So these are the common things I often have to correct with people.
Couple questions.
Yes.
Okay, got 2. We'll start with, if a client owns an industrial building with no loan, should they get a loan before selling it if they want to get a new loan to purchase a new property?
That's a great question, because frequently people will say, well, I don't really want to put all my equity into the new property. I want to keep some cash. And if you want to keep some cash, the problem is if you do it as part of the exchange, it becomes boot. So the question always is, can I refinance? Can I get a loan against the property and then sell the property? And the answer is, it depends how quickly you do it. If you pull money out of a property just before you sell it, the IRS would call that what's called a step transaction and still could tax you on that money. The recommendation by people in the exchange business is wait 6 months. If you want to pull some cash out, then sell it 6 months later, you're probably going to be okay. The other thing you can do is do the exchange, put all the money into the new property, and then refinance. The IRS literally has told us you can refinance immediately after you finish your exchange and buy the new property. They don't care. If you do it before, we do recommend a seasoning period of 3 to 6 months, something that separates the refinance from sale of the property. Jody, you said there was a second question?
Yep, and another one came in. So we'll do one more, and then we'll get you rolling, and we can and then ask the third one.
No problem.
Okay, if a 1031 property was a separate property before marriage, then rolled into a different property during the marriage, how does this new 1031 property split during the divorce? Is it still separate or is it communal?
Oh, well, that's a very loaded question. All right, so let's take those as two separate questions. First off, everything really depends on who's on title of the property. If you, Jody, I'll use you as an example, you bought a property when you were a single woman, you're now married. The first question I typically get is, can I buy my replacement property with my spouse? And the idea is really that is no. Adding a spouse during the exchange process is potentially harmful to the exchange and could disallow part of the exchange. I'm not going to get into the details of why, but you want it to be consistent. So if just Jody is selling, it should be just Jody's buying. If you want to add your husband to title prior to escrow closing, so that is the both of you selling, so the both of you are buying, that's okay. But adding a spouse in the middle of an exchange is a problem. Now, divorce. Divorce is really a problem, because the problem with a divorce is that until the divorce is final, there has been no separation of assets. And I have had numerous situations where people are in the middle of a divorce. They all said, oh, no problem, we know exactly what we're doing. And then one spouse thinks it's gonna be 50-50, and the other spouse says, oh no, I get 80% of the property because it's mostly my money, I came into it. My suggestion, if someone is going through a divorce and they want to do an exchange, wait until the divorce is final, or at least wait until there is a final separation of assets. Because if you don't, especially if they've continued to file their taxes jointly, having the two of them sell the property if they're both on title and then going their own separate ways really is problematic. Now, we could talk about this for quite a long time, but again, the key here is the vesting issues in the exchange are very important, and we're going to touch about that a little bit more. Jody, was there another question, or do you want me to just keep going?
Keep going. I got two more that are in here. So after this piece, I'll read the two.
All right, sounds good. We got about 10 more minutes, and then we can get into it. All right, so what are some of the big red flag problems when it comes to exchanges? Number one, family. The IRS hates your family. Actually, more specifically, they know you hate your family, and you would never do real estate transactions with them. And the key here is that there are restrictions done when you're trying to buy and sell property with family members or related, some other kind of related party as part of an exchange. And the way these are written, it's almost impossible to buy replacement property from a family member. A common thing people ask me to do, well, I'm going to do an exchange and buy my daughter's house. No, you're not. Because if you do, that would be in violation of these related party rules. Again, the takeaway here is, if you know anybody who wants to do an exchange where they want to buy from or sell to family members as part of the exchange, call me. Sometimes it's okay, sometimes you can't, sometimes you can do it under special arrangement. So family can really be a problem. Seller financing. Seller financing, I think, is a wonderful tool if you're cashing out. Seller financing as part of a 1031 exchange is a nightmare, because that note will almost always become boot and taxable. Now, we are not seeing a lot of seller financing in the Bay Area for residential real estate, but it's very common for commercial, for agricultural, in certain communities. But seller financing and 1031s do not mix. Vesting. And this kind of, we've already answered part of this. The key in an exchange is it has to be the same tax reporting entity selling and buying. Now, where do we see problems here? Adding a spouse, definitely a problem. Another problem here is when you have the property in some kind of irrevocable trust or partnership or LLC. Now, any entity can do an exchange, but it has to be the same entity selling and buying. LLC sells, LLC buys. Corporation sells, corporation buys. What I often will have is somebody who wants to dissolve the partnership or LLC, and each one ever goes their own separate ways. That's a problem. My suggestion is get the title report, look who's on title of the property. If it's not the same entities wanting to buy and sell, call me, let's figure it out. Sometimes there's an easy fix to it, sometimes there isn't. But vesting, change, any kind of change of tax reporting entity is a problem. Foreign sellers. If you are working with somebody who is not a US citizen or a permanent resident, please let us and the title company know immediately. Because if they are going to be subject to FERPTA, then there is going to be withholding almost always done by the title company. And we require that the client have a social security number or tax ID number. And if they want to get a temporary one, those can take up to 5 to 7 weeks sometimes to get. So if you're dealing with somebody who's a foreign seller who wants to do an exchange, bring it to our attention as early as possible, because that really can complicate the transaction. The last thing to be careful about is security. Please remember that intermediaries are not regulated. Please only work with very large companies who are bonded, who are insured, who are guaranteeing that your money is going to be there when you need it, because there are a lot of small exchange companies who will do your exchanges for just a few $100. The reality is that your money is very much at risk with those companies. Be very careful. All right. Why do people do 1031 exchanges? Now, most people would answer to this because they want to defer taxes. And that's really not the reason people do exchanges. The reason people do exchanges is because they want to buy something better. Now, what does better mean? Better means whatever the hell the client wants it to be, okay? The easiest way to defer taxes is don't sell it. But the reason people do exchanges is because they want to buy something that's better than what they own today. Maybe they want to diversify their portfolio. Maybe they want to sell 5 houses to buy a shopping center. Maybe they're moving to Arizona, so they want to move the rentals to Arizona. Maybe they want to buy property with better cash flow. Maybe they're running out of depreciation, so they want to buy something to get new depreciation. Maybe they're doing an exchange because they don't want the kids to fight over their assets when they die, so they're going to do exchanges to different properties so each kid knows what they're going to inherit. The reason I bring this up to you is when you're talking about people who have a piece of investment real estate, don't ask them, do you want to defer taxes? Everybody wants to defer taxes. What you want to ask them is, what would you want to do with the money? What is a better property for you tomorrow than you own today? If you talk to somebody who's owned a rental property more than 10 years, 95% of them would want something different from what they own today. Maybe it's the neighborhood, maybe it's the cash flow, maybe it's deferred maintenance, maybe it's the tenant mix, who knows what the case might be. But when you talk to those people, the question really is, what would you want different? What do you want more out of your next property than what you have here? 1031 is an amazing tool. And when you think about it, real estate is the only class of assets that you can sell it and not have to pay the tax man every single time. Okay, you got stocks, bonds, mutual funds, art collections, all of that. That when you sell, even if you're going to buy another one the same day or the next day, you're going to have to pay the tax man right away on sale of those assets. With real estate, you don't have to. Real estate is the one thing that you can sell as long as you're buying other investment real estate, not have to pay the tax man every single time. So that's a beautiful tool. Use it. 1031 is the tool that gets you from what you own today to what you want to own tomorrow. Now, let me add a little bit to this. Today's market, I would say virtually all economists believe that we are going to be going into some kind of recession. whether it's a V, L, W, all the different kinds of recessions, how quickly we are able to bounce back from this, who knows? But the reality is we will not be back to full employment in 6 months. Okay, the economy is going to take a while to lag. When the economy lags, real estate prices are going to be affected. Now, this is not 2008. Okay, we are not going to be in a market where the prices of real estate are going to be going down 30 to 80%. Okay, and though I will say in some markets, you will see you will see real estate prices go down, especially in really what I will call secondary and tertiary markets, properties or areas that have lots of fairly inexpensive real estate. You're going to see the prices of real estate go down if there's any kind of prolonged recession. And the reason I want you to think about that is when you're talking to your investors, back in 2010, 2011, I cannot tell you how many exchanges, I would say probably more than half of the exchanges that we did back then were people who were cashing out of the Bay Area where prices barely dropped at all and going to areas like Phoenix, Fresno, Texas, where property prices dropped 40, 50, 60, 80%, Stockton. And it was a great way for people to reposition their money to really improve their cash flow position. So, if we do start seeing a recession happening and we start seeing prices go down, then this will be an opportunity for investors to buy and reposition their money. I'm already hearing from real estate agents in places like Fresno and Redding and again, secondary markets where they got lenders calling real estate agents to do BPOs, for those of you who remember what a BPO is, because there are people falling behind on their mortgages. And again, if we have any kind of recession, there are going to be foreclosures. There will be price drops, and this will be an opportunity. I hate to use that term because it sounds like you're being vultures, but the reality is prices are going to go down. Now is going to be a great time for people to reposition their real estate portfolio. So, and I think for the first time ever, we actually are looking at what might happen 6 months to 12 months from now. Now's a good time to start planning what you might want to do with that real estate. So just an idea of what you might want to be seeing going forward. Lastly, I get questions all the time for people who are seniors. I'm sick of my real estate. What do I want to do with it? There are a few exit strategies that you want to have available for your clients. Always, paying the taxes is always the easiest exit strategy. Not my favorite. Even less favorite, dying. Dying is a great exit strategy. Never recommended to your clients though. Seller financing. As I mentioned earlier, I think seller financing is a wonderful tool if you are cashing out. Because under seller financing, you get to stretch out your tax payment over many, many years. And at the same time, it creates a cash flow stream. When my father retired, he sold all of his real estate under seller financing. For 20 years, he got payments every month. That was a great way for him as a retiree to live off that money. Plus, he got to stretch his tax bill for 20 years. Seller financing, a good tax strategy for if you're cashing out. Do an exchange to where you want to retire to. I do a lot of exchanges to people who buy in the villages or in the Del Webb communities or to Hawaii or Scottsdale or Palm Springs. Places where when they buy the property, they are rentals initially, and after a few years of renting, now they sell the property and they sell their local property and then they move into it. So the idea of converting your 1031 into effectively your retirement home is a really, really good tax strategy. And it's something that I do for a lot of people. Notice one thing here. If your goal is to move into your rental, live in it for 2 or 3 years, and then sell it, that is a bad tax strategy because you will pay taxes when you sell that property. But if your goal is to move in there and live there 20, 30 years, ideally the rest of your life, that's a great tax strategy. There's no tax due when you move in. There's only tax due when you sell the property. Again, as estate planning, buy property that ultimately, so kids know what they're going to inherit. Lastly, buy real estate that's low maintenance. Typically, we think of triple net commercial real estate. That's where you're buying a McDonald's or a Starbucks or something like that, or a DST, Delaware Statutory Trust. That's where you're buying fractional pieces. of commercial real estate. The key here is very little management, very predictable cash flow, and it qualifies for 1031 because it is considered to be direct ownership of real estate. So these are just some of the strategies you may want to have when you're talking to your investors, especially your older investors, the retired investors who are kind of sick of managing real estate. There are some options for them. So with that, that's the end of my prepared talk. I'm sure there are a few questions. Jody, you want to go ahead and light me up here?
Yep. Okay, so our first unanswered question is, I have a client that wants to sell her lake house, has tenants there most of the time in Wisconsin, and buy something here in California. How much time does she have to purchase for an exchange between the time they sell and buy?
It's a regular exchange. So 45 days from when that Wisconsin property closes escrow, she has 45 days to tell us what she's going to buy in a replacement, and 180 days to buy it. So, you know, I don't know what the market is like for lake houses in Wisconsin, or how long the escrows are. Frequently, when it comes to places like Lake Tahoe or, you know, real vacation type properties, they often will have very long escrows or very flexible escrows because the buyer's not going to move in. They're going to use it as a second home themselves. So there's a lot of flexibility there. So that's something obviously she needs to discuss with her agent in Wisconsin. But yes, she would still be bound by the same 45 and 180 days as a regular exchange.
Okay. And then this person arrived just a little bit late. So they have the question on, if I own a rental property and have not lived in it, can I use 1031 exchange to purchase another rental and have taxes deferred?
That's exactly what 1031 is for. You're selling investment real estate and buying investment real estate. So yes, that's exactly what it's for property, is not for property that is currently your primary residence.
Okay, and then somebody has their hand raised. So my question to you is, I'm more than happy to unmute and let them ask the question if you're okay with that.
Oh, of course, yeah.
Okay, I think it's Nassif. I'm gonna unmute you if you've got your hand raised. So if you can unmute yourself, and then you can ask your question.
Hey, Nassif.
I asked him to unmute himself.
The lower left is where you unmute yourself.
If not, you can put your question in the chat box. Does anybody else have any questions? Feel free to raise your hand if you do. You can do that by, you click on panelists, and then you can, you know, raise your hand and I can unmute you. Or if you have any questions, you can put them in the chat box or the Q&A box.
Right. While people are maybe doing that, just a couple things I want to finish up with. If you want these slides, send me an email. I'm happy to send you the slides. If you want to be added to my newsletter, it comes out usually once a month. I'll be happy to add you to that. It's usually about 1031 and tax related information, hopefully stuff that's useful to your business. But however I can help you, if there's any follow-up questions that you want to ask me one-on-one, happy to do that. You don't have to do this forum in order to, you don't have to do it in front of everybody if you have very specific questions. So I'm happy to talk to you as well. Anything else come in, Jody?
Nope, I haven't seen anything else come in. So I think we're good. Nobody else raised their hands. I haven't seen anything else come in. So again, this was recorded and we'll definitely post it to the SCORE website. And then if, again, Ron's email's right here. So if you want to take a screenshot or a picture with your phone and send him any questions you have, or he'll get you on his newsletter.
And if anybody wants me to do similar like this for their office, I'm happy to do so as well. But thank you for having me, Jody, and thank you to SCORE.
We did just have a hand raised if you want to stay for a second, okay?
Sure.
Okay, hold on one second.
Yes, Vicki.
Vicki, if you want to unmute yourself. You should be able to unmute yourself.
Yes, I did. It showed up.
Yes.
Okay.
Perfect.
Hi, this is Vicki. So my question, and this may be something that you would need more information, but if you have two clients that have that just divorced, and they have a commercial property, and one of them purchased it from the other. With the 1031 exchange, can they just go from their half of the basis, or does it transfer the whole thing over and then they've got to get a property of equal value?
Okay, so did one buy the other out, or did they sell it to a third party and then each go in their own separate ways?
No, one bought it from the other one, and she overpaid, actually. It's worth about 1.65 and she paid 1.8. But now she's looking at selling that and purchasing another one. So would her basis be half, or would she take the whole? I mean, would her basis be?
This correct. I'm sorry. I'm sorry. Is it the person who bought out the other one, now that they own the entire property, they want to do an exchange? Or the person who got bought out wants to do the exchange?
No, the person that purchased the property from the other spouse wants to do an exchange.
Okay, so now they own 100% of the property, and so their basis on the property is essentially a combination of what they bought the one spouse out from, then their original half. The other half is what the original basis was. But the key in an exchange is, I don't care what the basis is. Right now, if they sell the property for, I'll just make up a number, $2 million, that's how much they need to buy in replacement going forward. So their basis really doesn't matter as far as the exchange goes. If they're cashing out, though, then yeah, their basis would be a combination of what they bought one spouse out for plus what their original basis was.
Okay, so if they want to do the exchange, let's say she purchased it for 1.8, which was 900,000 on her portion, then she would have to buy a property or exchange into properties at 1.8.
Well, is that what she's selling the property for now?
It's what yeah, that's what we're looking at. It would be worth between 1.7, 1.8.
Right. So she sells it for 1.8 now. Correct. That she would have to buy 1.8 worth of real estate going forward. Correct.
Okay. Boy, that's unfortunate. Okay. Thank you. Thank you.
I didn't see anybody else. No more questions came in, so I think we're good for now.
All right. Thanks for having me, Jody. Look forward to seeing everybody in person one day.
Thank you, Ron. Thank you, everyone, for joining.